Good evening. We will be talking about the 5 principles of finance, which are money has a time value, there is a risk for return, cash flows are the source of value, market prices reflect information, and individuals respond to incentives. The principle number 1 that we went over was money has a time value. A dollar received today is worth more value than a dollar received in the future. So saving money now is going to be worth more than saving potentially more in the future because time has value. Money with a time stamp has value. We can invest the dollar received today, earn interest, which I was just referring to, and thus in the future we will have more than $1 as we will have earned interest on the investment. So save now and flourish later. There is a risk-return trade-off. Investors tend to be risk-adverse and prefer certain return to uncertain return. Investors will hold risky investments if they expect to be compensated with additional return. Higher the risk, higher the expected return. We notice that the return may not be equal to the realized rate of return, thus higher risk does not guarantee the higher rate of return. Generally, what I have seen with the market is that the higher the risk, the potential of the higher of return. However, when you have a higher risk, you may have a higher potential for loss. Principle number 3, cash flows are the source of value. Profit is an accounting concept and measures a business's performance. Cash flow is the amount of cash that can actually be taken out of the business. Company's profits can differ dramatically from its cash flows. It is possible for the company to report profits without generating any cash. Principle number 4, market prices reflect information. Investors respond to the new information by buying and selling their investments. The speed of investor reaction and speed of price adjustment determines the efficiency of the market. So 2 of the examples they had in the reading was release of good news releases higher stock prices, or is essentially higher stock prices. The release of bad news lowers the stock price. Principle number 5. Individuals respond to incentives. Managers, as agents, respond to incentives they are given in the workplace. If the incentives are not properly aligned with those of the firm's stockholders, the principal, they may not make decisions that are consistent with increasing shareholder value, leading to the agency costs. Yep. Money has a time value. What you invest now will obviously pay a higher return than you trying to invest a bunch later on in life. There is a risk. With every risk that we take, there obviously is the inherent risk of that investment. However, the return that we can potentially get from that pays dividends. Cash flow, cash flow, cash flow. You want to invest in something that does cash flow. You don't want a negative return on your cash on your investment. And market prices reflect information. So release of good news is going to spike the stock prices. Release of bad news is potentially going to lower the stock price. And as we saw with the last one, individuals respond to incentives. Incentivize your employees and they will perform well for you.